Good morning. Let's look at chapter 18, homework for leases. This has changed from what we've been using in intermediate accounting over the last few years. The actual policy and procedure changed in 2016 when it was decided that all of these leases, well, the majority of these leases is more than 1 year in length, would be put on the books as a capital asset and a liability. Prior to that, you had the four-way test on whether or not it was to be put on the books or not. And if the answer is yes to one of those four questions, as I pointed out in the lecture, then it would be capital. But most companies always found a way to make sure those leases stayed off the books, off balance sheet financing. But that's what changed in 2016. It wasn't implemented until 2019, January 2019, but there was obviously a period there of 3 years where companies were migrating toward getting all these leases that were operating leases onto their books. And of course, going forward now, we're in 2021. The text has finally been updated, and as well as the homework. So this video is going through the new homework that's been assigned. So let's just go ahead and jump in there. Let me share that screen here. All right, so here's question 1, exercise 1 for chapter 18. And it's very straightforward. They just want you to read the information, decide if this is going to be a finance lease or an operating lease. Now, when it says operating lease here, it's still going on to the books as an asset liability. So that's not the question. The question is how are we going to handle this, whether or not it's a finance or a operating lease. Terminology is similar to what it was before, but what's considered operating now is very different. So what we see here is Waseca Digital Solutions had a 3-year lease. Leased equipment has an economic life of 5 years. So, under the old standard, 3 divided by 5, 60% would tell you that that's less than 75%. So the answer would be a no. And that's what you see down here. That box is not checked. Item 3 or question 3. Required to pay $450 on January 1 of each year. So that's up front. Very important when we start doing this present value, because the present value is based on an annuity due, not an ordinary annuity. So very important there to use the right table. Of course, if you're using Excel, we'll see that you've got to put a 1 at the end of that expression. We'll see that here shortly. There's no bargain purchase option, and must return equipment at the end of the lease term. So that tells you 1 and 2 and 3 are all no, but what about 4? Present value. And so that's what we're going to calculate here. And when I pull this up using Excel, using the PV function there, equals PV, left parenthesis, the rate is 0.08, correct? Implicit rate is 0.08. Number of years is 3. There's the payment, $450. And there's no future value there. But then we want to use a 1 for type, because that indicates that this is an annuity due, D-U-E. If it was an ordinary annuity, like what we saw with bonds payable, right, investment in bonds, that would be an ordinary annuity, and there was no 1 there. It was assumed a 0. All right, so what does that give us when we plug that in? Well, the answer is $1,252, right? And then there you see the calculations. Lease term doesn't say 75%, does it? It says lease term is a major part of economic life. Leaves some area for judgment. And they've added a 5th item here now called, is it a specialized leased asset? Well, there's no information there. But regardless, it tells us the present value is substantially all of the fair value, right? Used to be 90% was the bright line calculation. So this tells us this is a finance lease for the leasee, because at least one of those group 1 criteria are met. There's group 2 criteria if this was whoever they're leasing this equipment from, but that's outside the scope of this exercise. All right, number 2, somewhat similar here. And what we see here is, well, you can read that for yourself, 8-year term, no purchase option or transfer of ownership, must pay $3,000 on January 1. Implicit rate's 5%. 40-year life, $45,000 of fair value. So what does this look like when we, again, use the PV function? 0.05, 8 years, $3,600. Again, it's an annuity due, so we put in a 1 instead of a 0. And so that tells us that the present value is $24,431. Well, the answer is no, no, no. All right, 8 divided by 40 is 20%. No, for present value is only about half, and there's not enough information about this being a specialized leased asset. So that tells us this must be a operating lease. But again, this is going to go on your books as an asset liability. That's the big change. Before, most of these leases were operating leases, because all of these, like in this case here, this would have been an operating lease, but operating lease in the sense all you did was debit lease expense and credit cash or accounts payable every time you made a payment. There was no liability on the books. That's what's changed. It's really what this chapter is about, the asset liability model. All right, what about number 3? All right, now we're getting into some journal entries. Jerris Works, Ironworks signed a lease on January 1 with Chung Bank. 10-year term, no purchase option, no transfer of ownership. Again, they're telling you the answer to those first 2 questions in this 5-question checklist. Must pay $4,200 on January 1 of each year. Implicit rate is 9%. So there is, I guess we read out here on the right side is the rest of this. 20-year economic life, fair value of $46,000. They tell you the present value is $29,380, right? And so the lease agreement is classified as an operating lease. But again, it's an operating lease. And now, unlike what we saw prior to 2016, that right of use asset, this is going on my books as an asset, which I'm going to depreciate. And then there's my lease liability that I'm going to pay down with each payment. And of course, there's the first payment, which is the same day, right? January 1, January 1. All right, lease liability is being paid down in cash. Then at the end of the first year, when you make your second payment of $4,200, well, it won't be $4,200. It's going to be, well, yes, it is going to be $4,200. So $4,200 cash payment that we're going to make at the end of the first year or the start of the second year, I guess is more accurate. We then calculate the interest expense at 11% times the $29,380 minus the $4,200. So $29,380 minus the $4,200 times 11% is going to be your interest expense. All right, debit, credit, again, is cash, and the lease liability is going to be the plug number. And so we do that every year. They didn't carry it on, they should have. All right, number 4. Chapin's Manufacturing leased a piece of non-specialized machinery. 6-year lease, $2,300 due at the beginning. Remember, all these leases, you got to pay up front. They're not going to give you an asset and say, well, pay for it at the end of the first year. It's going to be paid up front, and normally it's going to be paid monthly, not annually, like Pearson has you think. And so it says the present value of the lease payments using 11.5% is $10,695. So they're giving you that information here. So the lease term is a major part of the economic life, right? 6-year lease. It's supposed to have a 6-year life, so it's 100%. Present value. All right, I guess I could click on the solution here. Present value is $10,695 divided by $10,695. That's 100%. So both those are 100%, well beyond what you would consider a yes. And no information on specialized leased asset. All right, and then the first year's payment, present value of minimum lease payment, $10,695. Well, you're making the first payment right off the bat, so that's not included in your first year's calculation of interest expense. So $10,695 minus $2,300 times 11.5, that's going to be my interest expense for year 2, the start of year 2. All right, and then there's my amortization, or some would say depreciation, $1,783. Let's see what that looks like here. All right, there's my right of use assets on my books. I'm going to depreciate or amortize. There's my lease liability. And right off the bat, we're going to reduce that lease liability by 2,300, leaving my balance there to multiply by 11% to get 965. So 10,695 minus, right? Think of that, that's on your T account as a credit. There's my debit. So the balance then times 11% is 965. And then there's my amortization at the end of the year. And this is in the year. They're not showing you the actual payment, which is due the next day. They're doing the accrual basis of accounting to show the interest payable. The next day you would debit interest payable, right? And then credit cash for $2,300. And then the difference would be a debit to what? Lease liability. So your lease liability, it's the effective rate of interest method. Same thing we did in bonds payable back in chapter 14. All right, number 5. That means you got to click on some of them that gives you the information. Here we got a 16-year lease, $4,300, due on January 1 of each year. Present value of the lease payments using 12.5%. Assets fair value on the date the lease is signed, both $32,820. So they're giving you that information here. Orion paid fair value to acquire the equipment before lease commencement. Lessor's implicit rate is 12.5%. All right. And we're making entries for the lessor, it looks like. Yeah, Harris Manufacturing is leasing from Orion. So prepare Orion. So now we're doing the lessor. We have been looking at the lessee, but we're doing the lessor now. All right, and this is sales type. It's not direct financing because it tells us up here, because those are the two types of lease. When you get into leases for a lessor, you know, you got group 1, but you got group 2 criteria. But it's also, is this a sales type lease, meaning they've got equipment that they're selling as a part of this lease? Or is it just a direct financing lease? Like if it's GE Capital that you're using to lease something from someone else, right? Sometimes companies you buy from do the leasing arrangement through someone else, but not always. All right, so there's my $32,821 net investment in lease. And this is the lessor, right? Investment in lease. They're taking off their books. Well, the net investment in lease, $32,821. There's my sales revenue. I've booked that, right? Then the second entry that they grouped together here is my cost of goods sold. So it's coming off my books as inventory, $32,821 to debit to cost of goods sold. So I'm booking both the movement of that asset from my books at Orion to Harris, right? And Harris books, if you were doing this sort of side by side, Harris is going to have what? A debit to right of use asset and a credit to the liability. So the credit to the liability is in conjunction to the investment and lease from Orion's standpoint. All right, and then there's the first payment because that's January 1 of year 1. Then there's the actual first payment, which is going to reduce what? It's going to reduce we used to call it accounts receivable prior, but now it's an investment and lease. We're going to reduce that investment and lease by $4,300. And then my interest receivable, $35.65. What's that calculation? Well, it's my $32,821 less that lease payment, because now my net investment is down by $4,300. So whatever that is, times 12.5% gives me $35.65. So this is interest revenue. You know, if we were looking at Harris Manufacturing's books at the same time, this would be what? That $35.65 would be on their books, same calculation, but it would be interest expense, right? Harris's expense is Orion's revenue. All right, number 6. Interesting exercise here where they want you to allocate the lease component and the non-lease component. What you see there is the server percentage of 750,000 divided by 1 million to 75%. And obviously that leaves 25% for the 250,000. You see it right there. So then we want to use those calculations, right? Well, we first want to consider what's the total, which is the 390,000 that we're going to be paying over the 5 years, right there. That is 1,950,000. And so we're going to take 75% of that 1,950,000, get our 1462, right? There it is. And then there's 25% of the 1950. Of course, we're doing the same percentages. 75% of 390 is 292.5, and 25% of 390 is 97,500. So that's how we need to allocate the total contract among the lease component and then what's non-lease component. Because consulting and training is not a part of this lease, not a part of the capital, is it? Now that's something to go back to your chapter, I guess it's chapter 11 in your text, long-term assets, depreciation. What is a part of your construction in progress, your CIP, that eventually becomes an asset to be depreciated? Installation charges, costs, labor, and so forth, all gets tacked on to your project, but you never include training as a part of your capital, right? That's rule number one. It's just like research and development costs. Those are always expensed, never capitalized. And so that's what they're saying here with this consulting and training services. All right, number 7, I think is very similar. So we'll just skip on through that, but there's a solution with the numbers if you want to pause and look at that and work it yourself. I won't need to elaborate on it. So that brings us to these last two, 8 and 9, which are a little bit lengthy. Let's just go ahead and see what it says here. Here we have equipment has a fair value of $18,670. Title will be retained by the lessor at the end of the lease term. Economic life of the equipment is 6 years. Implicit rate is 9%. Lessee pays all maintenance to third party, no initial direct costs, no incentives. First annual payment is $4,800. And the payment increases each year by amount equal to $4,800 multiplied by the producer's price index, which is 5% each year. So they're making this a little more complicated, aren't they? It's not just $4,800, it's $4,800 first year, then it's $4,800 times 1.05 the second year, and then whatever that is times 1.05 for the third year. All right, and this is increase in the payments will be at least 5% per year. Annually payments are December 31, year 1, December 31, year 2. So this is a 3-year deal, isn't it? All right. So there's our present value. Again, if we look at the solution here, it's a little more complicated. We can't use the annuity due. We have to do this as present value, right, of a lump sum. So present value of $4,800 the first year is what? $4,800 because you're paying it at the inception date. So the second year, or they call it year 1, right? End of year 1. A little confusing. It's $4,800 times 1.05, so that's going to be $5,040, and then that $5,040 escalated by another 5% for the producer's price index goes to $5,292. So we got a payment of $4,800, $5,040, and $5,292. So here's my 9% rate, right? Implicit rate. Period is 1, and then there's my 5,040. Or if you want to, you can come over here and use the present value. Of course, you'll get the wrong answer. More than likely, it'll be a little bit off. Present value of a dollar table. You can use that table right there. Present value of a dollar and do the same thing for 1 year at what would you say? What percent? 8%? 92,593. All right. And then you'd use period 2 for 8%, 85734, I believe, to do our second calculation. So there's my first one. Present value is 4624 for that first, it's actually the second payment. It's the first year, end of the first year, right? And then the second one there, the 5292, that escalation that we saw up here at the top, right there, 5292, which is 2 years out. It's the third payment, but it's 2 years out, is 4454. So there's my 3 payments, 4,800, 5040, and 5292. So I've got $15,132 that I'm going to have to pay over time, over those 2 years. Again, these are paid up front. There is no time value calculation for the 4,800 because it's doable upon receipt of the equipment. But there's the present value, right? That's what we just calculated using Excel, 13,878. So when we look at the group 1 criteria, which is only relevant for a leasee, there's no transfer of ownership, there's no bargain purchase. Lease term, 3 years divided by 6, 50%, that's not a major part of the economic life. What's the present value? 74%? Answer's no. There's nothing about a specialized leased asset. So what do we have here? We have an operating lease that was still going to go on the books, right? All right. So what does that look like? Keep this handy. There's my 13,878. That's the present value. That's always goes on your books. Right of use asset, lease liability. Even though this is an operating lease, right there, see it? None of the criteria are met, but operating is a lot different. I keep saying this, it's a lot different than what it used to be. The lecture video talks extensively about the old policy or the old procedure on leases because you really need to know where you've come from. When you start working in leases, and I guarantee you will at some point, I did it every place I worked at, dealt with leases. It's just a fact of life. And it really helps to know where you've come from to understand what you're doing now. Why did FASB change that? It's because they want to get all this off-balance sheet financing, all these liabilities that are out there, these obligations on the books, right? Go back to chapter 13 when I talked extensively about commitments versus obligations. The company's committed and they have an obligation, so that should be on the books. That's the view of FASB. And so that's what we're doing here. There's the first payment, right? $4,800 is paying down that liability right off the bat, the first of 3 payments. All right, and then we have this chart to fill out here. A little confusing, but what they want you to do is show the 13,878 what the interest expense would be for each payment. Well, there is no interest for the first one, right? Because you're paying at the same time that you signed the lease, same day. You've got to make a $4,800 payment if they're not going to deliver the asset. All right, and so here we got year 2, that percentage, I've done forgot what it was, 9%, right? 9% times 9,078 is 817, right? We know what the payment is, 5,040, that's the 4,800 times 1.05%. And so reduction in the lease liability has to be 4,223, doesn't it, for this to balance? Which gives me a new balance for the 3rd year or 3rd payment, which is the end of the 2nd year. There's my 437, which is again, I got a short memory, 9%. 9% times 48.55, right? 437. You know what the payment is, which is 5,040 times 1.05%, 437. And so that's reduction of my lease liability to 0. Because that liability has to be gone at the end of those 3 years. All right, and then the amortization schedule, right? Release expense, 5,044, where does that come from? Well, what was the amount up here for the actual payments? Or was that? I guess it's in the solution. $5,044, that is my 15,132. So 15,132, because those are my payments. That divided by 3, 15,132 divided by 3 is 5,044. So 5,044 each year is going to reduce that right of use asset, right? It's going to reduce that to 0. Of course, that's 13,878, correct? But again, let's look at this reduction of my lease liability. So there's my 4223, which comes from year 2, well, year 1, end of the 2nd year payment, end of year one, 4223, reduction of the liability. There's my cash payment. Go with what you know. Lease expense, 5044. Again, for that total $15,132. That's what it was, right? Lease expense divided by 3, 5044. You're going to have that both years or all 3 years. And then there's my accumulated amortization, which is 4227. So the amortization is going to have to add up to the 13,000 back up here at the top, 13,878. All right. So once you fill that table in, that makes this lower part easier to follow what you're doing. I don't know that you need to click on these things because that's, you can if you want to. I guess that's why they put that there, so you don't have to keep going back and forth like I'm doing, right? Of course, you got to use both of those to fill this out. All right, and then there's the final 5044 for the total payments that have been made. All right, so that's problem 8. And let's look at number 9. All right, what do we got going on here? 5 years, Revive Sales Company. And so the requirements say we're making interest for the lessor. All right, what's the information? Not specialized equipment. Sales price, useful life 7 years. 12,000 annual rentals are due January 1. Incremental borrowing rates 14%. Carrying value of equipment 57,000. Book value, same thing, which is also the fair value. Tells you about group 2 because this is about a lessor. So it's not just group 1, those 5 questions, it's also about group 2. There's an interesting comment. Their implicit rate is not known. His incremental rate's 14%. All right, so what does that mean for us? Well, they want you to calculate the implicit rate in this exercise. So how do we do that? Well, we're going to use what's called rate function in Excel, right? Another one of those, I'll call it an advanced function. It's a function people don't normally use. But here we're using rate, which is equal to rate, left parenthesis, what's the number of years or periods. But here they make it easy because you're doing it annually. That's why they don't do this on a monthly basis, because then everything would be multiplied by 12, wouldn't it? Make it a little more difficult. So 5 years, 5 terms, payment's 12,000, and you're trying to figure out the present value is 57,000. Make sure you put the negative in there. And this is an annuity due for that 12,000. That's what that applies to. All right, and so that tells us that the implicit rate, when you click enter, is, and I would encourage you to do this on Excel in case you have one like this on the exam, you know how to do it, 2.6325%, right? Okay, and then also, if you're going to use that rate of 2.6325, that's the implicit rate, which is a lot lower than that stated rate by a long shot. That other rate was what, 12% or something? 14%. A lot less. So you want to use that using the present value function, equal PV, and the rate's 0.026325. 5 years, payments 12,000. It's annuity due. Those $12,000 is due at the start of each year. All right, and that says the present value is 57,000. So what does that tell us? Well, there's no transfer of ownership that was mentioned up there. There's no bargain purchase. Bargain purchase is like $1 at the end of the term, which is very similar to question 1. Is the lease term a major part of economic life? 71%, so the answer is no. But they're not saying it's 75%, which is what it used to be. They're just saying in general, it's not the major part of the life, even though it's more than 50%, right? Present value, 57,000 out of 57,000. That's a surprise, isn't it? 100%. So the answer is yes. So this is going to be a financing lease. And of course, this is a lessor. So there's the solutions, 2.6325. Plug that in. There's what we just looked at in the solution. Group 2 lease criteria do not need to be assessed due to the lease meeting the Group 1 criteria. But this is a sales type lease, not direct financing lease for the lessor. All right, so there again, similar to what we looked at in a previous exercise, net investment in a lease is 57,000. Again, that 57,000 for the net investment in lease is related. I don't like the fact they do it pertaining this way because the old homework had these as different numbers, difference between the value of the equipment versus the book value of the equipment versus what you're selling it for. But here they're making it all the same. Net investment and lease, that 57,000 is associated with the sales revenue. And then the cost of goods sold, you know, for managerial accounting, it's coming out of inventory of machinery, right? Which is cost coming off your books as inventory and going to cost of goods sold, going from the balance sheet to the income statement, right? Of course, there's no profit on it, but you still have to book it this way because this is a sales type lease. Sales type, not direct financing. Sales type leases are, you know, when I was at Exide, we leased all kinds of fork trucks from Bailey here in Johnson City and Caterpillar. And we not only leased through Bailey and Caterpillar, but they financed it as well. So those were sales type leases for them, if I was to look at their books. But sometimes you might buy let's say you bought a $10,000 copier from a company and they didn't have financing available because maybe it's a small mom and pop. They would do the financing through another company like GE Capital. And that would be an example of what we've set up through GE Capital would be a financing lease, right? There is no transfer of there is no sales, there is no cost of goods sold and transfer of the inventory. It's not a profit from a sales that's being made. They're making money on the lease and the actual interest that's being paid for that. All right, so there's the initial entry. There's my first payment. Again, you're making a first payment right off the bat, and so the lessor has to reduce their investment. Think of it in terms of a T account. There's my debit to an asset. Come off my books, right? There's my asset. Based on, and that 57 is not related to that. This 57,000 related to the sales revenue, which is present value. All right, that's present value. Present value. Just so happens these are the same. That cost of goods sold there and the inventory machinery, that's what it is on your books. It's not present value. That's the value on your books that you're moving off. That's why I don't like the fact they've got the same values here for some reason. All right, so then after we get through the end of the first year, then we're going to have interest receivable and interest revenue, aren't we? Well, what is that going to be? Well, it's going to be 57,000 less the 12,000. What is that? 45,000 times the implicit rate. Yes. See if that's on here. Yeah, there's my 57,000. There's my first payment, which we saw that journal entry, correct? Yes, so we have 45,000 times the interest rate. Where we get 11.9648? I forgot. I don't remember that. Oh, there it is. I must have skipped. Yeah, I did. I skipped part B, didn't I? No, they don't have that on here. This the calculation for this interest receivable, but that should be. Grab my calculator. Should be 57,000 minus 12,000. I shouldn't have to use a calculator for that, should I? Times, what did we just decide that rate was? 2.6325. 26325. Yes. So 2.6325% times 45,000, right? The 57,000 minus the 12, 57,000 minus the 12. My net investment in lease is 45,000, right? So net investment in lease is what you're using. 45,000 times that 2.6325 is $1,185. There it is. So there's my interest receivable. There's my interest revenue. Again, this is big boy, BBE, this is their books, the lessor. If this was the lessee, revived sales company, this same calculation here would be interest expense. Also be a debit on their books, right? Not a credit. All right, so then that brings us to part B, and they've changed it. It says, would the accounting for a lessor change of a third party guarantees a residual value of $15,000 and collection of this amount is probable. All right, so what does that look like? Because our implicit rate is going to change, isn't it? You see it right there. So we go down to part B, right there. $12,000 payment, $57,000. But we got this $15,000 at the end. It's future value, don't we? Make sure you get the signs in there right, or you'll get the wrong answer. It didn't make that much difference in bonds payable, but here it does. All right, so again, one is for annuity due, and that tells us that using this rate function in Excel gives us 11.9648. That's the implicit rate. All right, and the implicit rate, when we plug that in for 5 years, that $12,000 and $15,000 future value says that the present value is $57,000. Surprise, right? All right, and so then there's requirement C, where we want to put our amortization chart together, or interest expense, as they call it here. But it's really amortization table for the interest expense. 57,000 minus the 12 is 45 times this new rate, new implicit rate, because of that $12,000 amount at the end. Guess we don't need to look at that. Down here at the end. All right. And so that's it. So that's a rather long exercise, but it's a good one. Pull up the solution there again, down at the bottom. Payment reduces my principal. It's just like what we did in bonds payable and chapter 14 and chapter 15 on investment. All right. Thank you. That is chapter 18 leases. I hope you have a great day, and we'll talk again soon.